up, guys? What's up, everybody? Thanks for joining. Appreciate y'all being here. I'm Io. I realize some of y'all might be out there in your day doing important things. Anyways, this is kind of an introduction to trade essentials. Learn to trade like a pro. I want to start doing one module a week if you guys are seriously interested. Otherwise, we can get together and tell jokes and look at cool stuff. So I'm going to have a slide presentation for you, and I'll have notes. I want to take your time serious, and I would want you to expect nothing but the best from me. I'm always searching for quality in my life. Here we go. So this is going to be an introduction and what the upcoming modules are going to be. As we go, you can see here, this is going to be about mastering the game. We're going to be talking about everything from technical analysis to psychology, to proper risk management, to strategy. So this will be something you can kind of have a building block on. And if you guys have any questions, feel free to speak up. So, introduction. I'm sorry, I was like, whoa, can I not move my thing? Introduction. What are we going to be talking about today and covering? Risk management, trade setup, stop loss, invalidation of a trade. Those will be your parts of risk management. We're going to talk about the different types of candlesticks. When we look at charts, there's different ways of representing data visually on a chart. We'll, just talk real quick about the difference between a line chart, a bar chart, a candlestick chart. What is the anatomy of a candlestick? Number 3, let's talk about trade size and how to calculate correct position sizes. This is just as important as risk management, if not really falls into risk management. And then last, we're going to talk about margin trading, the pros and cons of trading with leverage. Leverage trading is like a two-edged sword, right, guys? Or a powerful tool, or whatever analogy you want to use. I actually myself first got into leverage trading when I realized that I was my fees on spot trading for spot volume were averaging about 1,000 to 2,000 a month in fees, say even on something like Coinbase. Now, granted, on other platforms it was a little bit less, but still about 1,000 to 2,000 a month in fees alone. I'm not saying that's always the best reason to switch to leverage, but even with using a very small percentage of leverage to cover basically your fees, your funding fee and your execution fee, it's almost like trading spot without the fees. So, what is a trade setup? A trade setup is a thorough plan where you've decided to enter a trade based off of technical analysis. An entry point is where you'll place your orders to enter a trade. A stop loss is where your position will be totally closed for a loss if hit. And a take profit is where your position will be totally closed for a win if hit. This image here, guys, we want to use this. This is just a general representation. Those of y'all new to trading, you'll start seeing this more often. This is a candlestick chart, and what you see here typically is a green and red box. This would be a long setup, right? So no matter whether it's going to be a long setup or short setup, you'll see that this midline that goes through dividing the colors is actually the entry point. And in red here, this is representing when you be a negative in the trade. And then at the very end of the red box would actually be your stop loss. Sometimes we'll also you'll see boxes, parallel lines. We'll talk about more of this later on. So a take profit is where your position will be totally closed for a win if hit. I put on here like making hasty purchases due to fear of missing out or emotional trading is an unwise approach. A stop loss not placed is not just placed in like an arbitrary place, right? Something I want you to understand is, as we're as we're learning about risk management and technical analysis, and here on TradingView, I'll go ahead and bring this up. This is where you can find a long or short position tool if you wanted to. So if I wanted to make it look like the example, I'd come over here and I'd click once to plot my long position on the chart. Then I would use either dragging to adjust my stop loss level and take profit level, or I can right click and go into settings and manually enter the exact price points I want. Why I wanted to mention this too real fast is when we talk about risk management, guys, why, for example, you can't just place your stop loss in an arbitrary place is because it'll adjust completely like your risk management and your risk reward. Typically, in general, we tell traders starting off, you want to look for 3-to-1 risk rewards. What does that mean? That means the upside potential is 3 times greater than the downside potential. So as you can see here is a 3-to-1 risk reward trade setup on my chart. And you can see this represented here by this 3 period and then the number afterwards. You'll also see that commonly sometimes in trade nomenclature. I want you to notice one thing here. As I move my stop loss position, let's say down some, I'd rather keep my stop under this last candle, which is also a common mistake in a way many traders get liquidated, but we'll say that for another time. But see how I moved my stop loss down some, guys? It seems just like a little bit, not a big deal, right? I thought, well, maybe under this candle would be a good place. Right there, my risk reward completely changed. It's now 2 to 0.3. It is no longer a 3-to-1 risk reward. And so this isn't so specific, you got to get it right now today, but this is more just to keep an idea in your head how many different things affect your risk management. And there are many schools of thought in trading and everything else. There are, even a school of trading like that's commonly referred to as ICT, I tend to be a fan of. There's many that say that it's not necessarily the ICT trading that makes those successful. It is just the risk management that is practiced in that. Hey, welcome, Improv. Feel free to jump on in anytime you want, or if you have any questions.
Man, thank you. I didn't want to miss this, but
Cool. We're recording, so that's same thing. We're starting to talk about risk management here, but I was just highlighting the importance of everything that we do with technical analysis, even if it's just moving a stop loss, will affect our risk management, and why it's important to kind of be precise and be statistical. Same thing with a take profit. Like, take profits essentially in order not to get greedy and wait for some movement to occur or lose profits, right? So there are some common tricks and advantages you can take advantage of, say when you're leverage trading, by moving a stop loss up into profit and other tactics, and we'll save that for another time too. But just, we'll have a trade plan and we'll stick to the trade plan, either take profit or stop loss. We're not adjusting halfway through. That's the important thing I want you to gather here. So in summary, real quick here on risk management, trading is a probabilities game in which it's impossible to expect a 100% win rate over time. Know where your invalidation is before you enter a trade, right? So that goes back to have the trade plan before you enter the trade. Know where you are wrong, just as is important as where you are correct. And be able to recognize it, because it's not something you're going to get correct 100% of the time. And if you stay here trading with us, you're sure as heck not going to get 100% wrong all the time. Always place a stop loss, as is there to protect you. Don't get greedy, and eventually see wins turning into losses. Have a plan for every trade before you enter. It is very important. And don't be afraid of taking a loss. It's normal in trading. You just have to get into a point in your trading career when you take more wins than losses, and that'll come with time. It definitely will. And at some point, I'll mention too, like you can be very passionate and wanting and eager to either start being a day trader or start being a more profitable investor. But also, like, over trading is like a real thing as well. And we'll talk about maybe ways to recognize that at some point. So that kind of covered the general part of risk management that we'll talk about. Now we're just going to talk about very briefly the different types of charts. We'll be mainly using just one type of chart, which will be a bar chart or a candlestick chart. We'll get to that. But going back, this is like what's generally referred to as a line chart. It's an older Western type of chart. It's among the simplest ones. It simply represents the progression of price over time, right? So not that everybody needs to be a statistical expert, but typically we talk about things on scale, right? And so you can see here going from left to right on our horizontal axis, this will be representing time, whereas up and down on our vertical axis, this will be representing the value of an asset, or usually its price. This type of chart, known as a line chart, is often used in financial markets to analyze trends of a particular stock. By plotting price over time, traders and investors can gain insights into performances of the asset, make informed decisions about buying and selling. Despite its simplicity, the line chart remains a powerful tool for visualizing data and identifying patterns in price movement. We still use something that looks similar to this line chart, which will be one of the first things that we'll be using in trading, which is like an oscillator, an RSI or a stochastic RSI, and this consists of a simple or line chart, and this indicator will help us spot kind of early on momentum plays and or trend reversals using something like that. So next here, this is what's referred to as a bar chart. This is a more old-fashioned one, almost Rinko. It gives more information. Green and red colors give insights where the price has moved up or down between a given time frame. You can see the relationship when the price is open and close in a given time frame. Right, so just very simply, right, each bar on our chart represents a period of time. So if this was a daily time frame or a 1 hour time frame, it doesn't matter. Each one of these bars or candles would represent one period of that time. So on a daily time frame, each one of these bars would represent 1 day. Also, whether they closed red or green, indicating bullish or bearish. Green would be positive price action, red would be bearish. As you start to move along in your trading, you'll sometimes see other color schemas or color schemes used, just typically one being lighter and one being darker, indicating closing below or closing above in price the preceding candle. Additionally, by seeing the relationship between price as open and close, traders can gain insights into how much volatility there is in the market, how much risk they may be taking on with a particular investment. Overall, having access to this type of data can be incredibly valuable for traders who are looking to navigate complex worlds of financial markets. That was a mouthful. I'm sorry. And then last, Japanese candlesticks. I should have really kind of probably put on here Helsinki ASCII. And excuse me, my friends over there, if I mispronounced that or slaughtered the enunciation. Similar to a bar chart, easier to read. This gives clues on what might happen next, as you can distill patterns. For the most part, most of the trading I'll be teaching or sharing, or even charts I share in my day-to-day trading. Just so the rest of y'all know, I'm using normal, regular candlesticks, right? Like we just talked about. I'm not using Helsinki ASCII. And not to go into too much detail about those, but you typically see further wicks and longer elongated wicks on these candles. I'm of the opinion it's much harder to derive real good levels and being precise when using those type of candles. I gotta figure out something so I don't have to keep moving my big head around. So let's talk about, we talked about the different types of candlesticks. Let's talk about how to read a candlestick, right? Candles refer always to a given time frame. We talked about that just briefly a little bit earlier, but each one of these candles here is going to represent a period in that time frame. So once again, if this was a 5-minute, which would be referred to as a low time frame. When we start talking about time frames, guys, you'll hear a lot of high time frame and low time frame, or HTF and LTF. It's just it's not slang. It's just how we describe time frames, right? So higher the time frame would be, think in your head like a daily time frame, or like a 4-hour time frame, or a weekly or monthly. And when we say like a low time frame, we're typically talking 4-hour, maybe generally I would say 1-hour time frame or below, 15-minute, things like that. And then the next couple of weeks we'll start talking about using multiple time frames or a multi-time frame setup. And that'll be the power of when we're looking at something like a higher time frame and then dropping down to a lower time frame. So looking at something, say, on a daily time frame, and then looking at something on a 1-hour time frame, or a 4-hour and a 15-minute, or some combination of that. So every candle equals an interval of time. The difference between the opening and the closing price is called the body of the candle, right? So that's the thick parts. Whereas these parts, these thin parts on the top and bottom, are going to be called the wicks. The highest and lowest price in relationship to the candle body forms a shadow or a wick of the candle, right? So this would be a wick, this would be a wick, but the body close, right? Those are what gives us our significant levels. Quick random note, the only thing I draw from wicks when measuring levels typically and things like that are fib levels, as well as obviously when we start talking about liquidity and order blocks, we'll use wicks of various candles to help find those as well, but that's not important for right now. Let me drop over to a chart here, and we'll just look at another practical example here. So this is a 4-hour time frame, and how you'll know what kind of type of candlesticks you're on, right, guys, is right here. If you're in TradingView, you'll select candles. Now granted, you could use hollow candles. They paint the same on the chart as regular candles do. The only difference is it's just using hollow candles for bullish, and green and red being bearish, solid candles for close. And I'll give you an idea of Hokinashi candles. You'll see how these have generally longer wicks on them, guys. These are the newest candlesticks invented, but and some newer traders use these. I did for a while until I found I had much better results using normal candles. So, and like I mentioned, the most part, we're going to be talking about using these candles when we're learning technical analysis. So, once again, we're looking at bodies of candles here, right, versus the wick. So, any of this would be a body of a candle, right, whereas this would be the wick of a candle, or this would be the wick of a candle. And what actually is happening here, and why we're getting these on the chart, is these candles here, you'll see. So let me take one here with a wick or something that's just a good example, easy example to use. For example, this candle right here on our chart, our wick went all the way up to here, and our wick, ends down here, right? So what happened is, during this time frame, this 4-hour time frame that this candle represents, the highest price it reached in that time was all the way up here at this level at 41,540, and the lowest price it ever touched in that time period was all the way down here. But when the 4-hour period was over, the price closed here. So that's what gave us a bullish candle. So when we are then going back and looking for levels, and we'll talk about this in our next module, drawing parallel or horizontal levels when talking about support, resistance, and pivot points and all those other good things. We will use candle bodies, right? The close of candle bodies. For example, here I'm going to use the candle body close, and you'll start to see as you practice technical analysis how more and more of this lines up and why we want to use candle bodies versus wicks and why. I just wanted to point that out. So closing price, opening price, highest price of the time frame, lowest price of the time frame. Candlestick summary. Candlesticks consist of 4 elements: the open, the high, the low, the close. And source 3 if you are coding in PineScript. They give insights on how price has behaved within a given time frame. The body of the candle represents where has been the most interest during the candle time, right? So you can think of this too as a great way to be able to help visually spot volume and where the most volume was traded, meaning where was the most activity or price activity taking place? Where was all the trades? What were they battling for? What levels? This is what the actual candle body represents. These wicks are visualizations of where price attempted to go but failed to remain. And using these wicks and candle bodies, we won't go into huge depth, but at some point we'll talk about, there's all kinds of patterns traders look for on charts, right? Whether it's a symmetrical pattern, something consisting of several candlesticks, but there's also patterns or candlesticks that are identified just by themselves, by the singly or 2 or 3, and that have different names and meanings as well. I personally am not very much of a pattern trader, but there are patterns we'll discuss that have high probabilities and are a good place for beginners to learn. Oh, that's old. Sorry, I left that in. So next we're going to be talking about margin trading, what it is, and what we can do and how we use it and things like that. I'm sorry, I'm getting off base here because my slide is somehow wrong here. So this is going to be we're going to talk a little bit about trade size. Actually, I got this wrong. I'm sorry. Margin trade will be next. So always, this will be an example. So always know your risk before you enter a trade. You must have set up a play before entering the trade. So we're going to do a little math example here, and then we'll move on. So let's say you have an account, a $5,400 account, right? And we want to risk 1% loss of the portfolio with each trade. So we'll take 1% of a $5,400 account, which gives us $54. So how do you come up with that, right? Your trade amount will equal, right, your risk amount in dollars divided by your stop loss percentage given by a trade setup times 100. And there's many calculators, risk calculators. A lot of exchanges now have these as well built in. Sometimes they're harder to find, but and I even have a spreadsheet that I'll share with you guys that if you want to do these calculations or if you want to log your trades, which is another thing I would highly suggest. What I'm trying to say is you don't have to memorize all this. Some of these tools have already been built or shortcuts made. So for a trade with a given stop loss at 4% from the entry point, we have the trade amount equals 54 divided by 4 times 100 equals 1350. We are risking 1% of the total portfolio with a 4% stop loss trade. Hope everybody could follow that. Now here, margin trading, leverage trading. Leverage trading allows you to trade with a larger position size than what you have available, borrowing the amount from the exchange. So what are the pros and cons of this? Why do people do it? Why do I do it? Because I'm a degen? Maybe. The pros are like you can trade more contracts than you have, right? You can reap larger rewards. You can grow your account quicker. And you can have less exposure if used correctly. Some of the cons, are obvious. Larger losses if price turns against you. You can lose money quicker. The more leverage, the closer your liquidation price will be. Trading a high leverage is extremely risky and is not recommended. No more than 5x for beginners. So, guys, I think sometimes, especially for newer people starting off, you see these guys posting these big wins, these big P&L wins and everything else. And you may get frustrated, or you may just want to post, an awesome win yourself. I mean, who doesn't want to post a 200x, 100x? And trust me, you'll get there. But what really you need to be careful of, it's not worth it. Anybody can go and open up some crazy trade and put it on 50x leverage or 80x leverage and maybe pull up a screenshot of 100x or 200x P&L, right? And post it. But more than likely, you're just paid to do that because they might have gotten liquidated while they were taking the screenshot before they even closed the trade. I mean, this is crypto. It's very volatile, guys. I'm not saying you can't trade with 10x or 20x. I'm not saying I don't trade with higher leverage than 5x. But I'm just saying be careful. Be careful. There's a reason why we start with risk management and then get on to the other stuff. We can talk about trade psychology all we want and have a healthy mindset. But, if we don't talk about risk management first and you have nothing left in your pocket, I don't know how well you can get your mindset. Margin trading example. 1x leverage, right, would be $1,000 position size. If price increases by 1%, you'll have $10 in profit, right? Because 1% of $1,000 is $10. If price drops by 1%, you'll lose $10. Now let's see what this looks like with 3x leverage. So $3,000 position size instead of 1 will be borrowing, $2,000 will be borrowed from the exchange. If price increases by 1%, you'll have $30 in profit versus 10. But if price drops by 1%, you'll lose $30. See, are we following? Margin trading. Use leverage sensibly. Going all into one trade indicates poor risk management. I will repeat that. Talking about psychology, which we're not doing today, but revenge trading, guys, or like you get a trade wrong, or you have a trade plan and you get it wrong, which will happen. Like the last thing you want to do is just open up a trade for the exact same amount or double the amount in the opposite direction because you figured, okay, because right when you do that, that's when the trade will go your original trade plan's way. And that's a dangerous way to live. So use leverage sensibly, use adequate risk management. Here's a favorable example situation. Your portfolio is diversified across different exchanges and you're using multiple trading accounts. You have a portfolio worth $50. That's me, right? But only $1 are allocated on an exchange. The rest is another exchange or stored in a hardware wallet. You can use leverage to meet the desired position size even though you don't have the required money on the exchange you want to take the trade. With the appropriate risk management, you can use leverage to take the trade with the desired position size without moving funds around. That's right, guys. I'm trying to get those Apple Vision Pros coming out in a couple days without moving funds. I'm trying to make a trip out to Cali to see my Beast brothers in February without moving funds. So this kind of wraps it up for today. I know you guys were out busy doing other things. I hope to see more of y'all in 2 weeks when we really actually start going on this. I have a lot of material planned that I want to do with y'all, and let's make money together. Let's have fun together. Let's make laughs. Let's learn. Let's not waste each other's time, and let's be about it, not just talk about it. So I thank y'all. I appreciate that. So we got some other people jumping in here. Hey JPEG. But I'm gonna go ahead and end this now, and I'll post the video, and we'll start getting ready to doing this for real. Thank y'all.
Well, thank you.